Hey everyone, I hope you guys are all doing well. We talked a couple weeks ago in our video about how we were going to come out with a series, four-part series in regards to different types of financing options that are available, including government financing, conventional, jumbo, and non-traditional financing. This video is the first video in that series, and we'll be talking today about government financing. Not going to get too heavy into the details because I would be sitting here talking your ear off and you would probably fall asleep. But I'm just going to give you a good overview on the different types of financing that's available for government loans. And as always, we're always here to answer any questions that you got, so please feel free to reach out to me at any point in time. The first government loan we're going to talk about today is FHA financing, which is a government loan program that's administered through the Department of Housing and Urban Development. FHA has been around for a while. It exists to basically create opportunities for home ownership with more flexibility in regards to credit score, qualifying ratios, required assets, things of that nature. The minimum required down payment for FHA is 3.5%. Although there are basically down payment assistance opportunities through the, we use North Carolina Housing Finance Agency quite a bit here in North Carolina, and they provide down payment assistance through the form of a forgivable second lien on the property. So there are state to state, you've got housing entities or organizations that are helpful in getting down payment assistance if a borrower doesn't have their 3.5% down. Minimum credit score requirement on FHA loans. FHA will actually allow down to a 500 credit score, but anything below 580 requires a down payment of 10%. And there's also some additional requirements in regards to assets and things of that nature. Most of the time, even though FHA allows down to 500, you're going to have a hard time finding a lender that will actually go below 580. Here at Cornerstone, we allow down to 600. We will go lower than that on an exception basis if the file is strong, if it's got good compensating factors like additional assets, low debt to income ratios, things of that nature. But typically, for the most part, we're in that 600 range. Debt to income ratio requirements, which is basically taking all of your debt, monthly debt, credit cards, car payments, student loans, things of that nature, along with what your projected house payment would be on the home that you're buying. FHA allows well into the 50 percentiles. So we frequently see approvals on FHA loans up to 55, 56, 57%, whereas most other loan programs are going to be considerably lower than that. FHA is lenient in regards to funds for down payment coming from family members as a gift. Money can be pulled from a 401k. Again, down payment assistance through government organizations and entities. So a lot of flexibility there. FHA is probably one of the most flexible loan programs that there is. So we use that quite a bit, especially for first-time home buyers that maybe don't have a ton of credit established and things like that. So FHA, that's number one. The second one that we're going to talk about today is the USDA loan. USDA is a government loan program administered through the Department of Agriculture. It's a great loan program. It's 100% financing, does not require any down payment whatsoever, but they're way more strict on multiple things regarding the loan process. For instance, credit score. In most cases, most lenders are going to want you to have a 620 or above. The USDA computer-generated underwriting system really likes files with 640 and above. Not to say that that's an absolute requirement, but it definitely makes things a lot easier moving forward. USDA is very strict on two things. One, the property that you're purchasing using USDA financing has got to be located in a USDA eligible area. Another name for the USDA loan program is called the Rural Development Loan Program. When I hear the word rural, I kind of automatically think of farmland somewhere, and that's not at all the case. The rural designation really is based upon the population density of an area. So the more densely populated an area is, the less likely it's going to be to qualify for USDA financing. There is a website where you can type in a property address and check for USDA eligibility. So that's very, very important. The second thing is USDA is basically exists to help low to moderate income households achieve home ownership. So it's got an income limit that you cannot exceed. If you do, you're not eligible for USDA financing. So that's the other big sticking point that you need to be aware of if you're entertaining looking at using USDA financing. There's also some strict requirements in regards to assets. So for instance, if you got liquid assets that would enable you to put 20% down on a purchase, you will not be eligible for using USDA financing because you have sufficient assets to qualify to use conventional financing with 20% down. So certain things like that, again, just sticking points with the USDA loan program. Lastly, they're super strict about your housing payment not exceeding 29% of your gross monthly income, and they want your total debt to income ratio really not to exceed 43% of your gross monthly income. Last loan program that we're going to talk about in regards to government financing is the VA loan program, which is specifically for veterans. It's a government loan program, again, that's administered through the Department of Veterans Affairs. Basically, our motto is you serve, you deserve. We love our veterans. Obviously, we want to make sure that we do everything that we can to make sure that they get their VA financing. The VA loan program is a great loan program. It offers 100% financing with no monthly PMI. It does offer, just as FHA does, a lot of flexibility for the veteran in regards to qualifying as it pertains to qualifying debt to income ratios. Assets, especially with no down payment, they really don't require a ton of assets. A lot of flexibility on debt to income ratios. If you are considered disabled by VA standards, even minimally, they do it on a percentage basis. But if you're disabled in connection with a service-related disability, you're exempt from something called the VA funding fee, which is if there was any disadvantage to using VA, it's the upfront funding fee that is collected as part of using the using the VA loan program. The VA funding fee is based upon a percentage of the loan amount, and it's basically gets more expensive the more times that you use it. So if you're getting 100% financing and you're a subsequent user of the VA loan program, your funding fee currently could be as high as 3.6% of the loan amount or the purchase price. So it gets, you're talking thousands and thousands of dollars. That money is rolled into your loan amount, so you don't have to bring it to closing. You could finance it in. But sometimes that makes a substantial difference on your monthly payment when you're rolling thousands of dollars into the loan amount. So something to keep in mind moving forward. Also, VA eligibility can be used by a surviving spouse of a military service member who was missing in action, POW, or was killed in action. So certainly understandable that surviving spouses of military members should be, should have accessibility to that loan program. Moving forward, obviously their family has earned it at that point. So that's the three government loan program types. Again, a brief overview of each. There's a lot more detail that goes into each of them, but that's the fine points of each. Again, as I mentioned earlier, feel free to reach out to me at any point in time if you want additional information and you want to discuss the possibility of your qualifications in using one of those government loan programs, and we'll be happy to help. Thanks so much and have a great day.